Hi everyone, welcome back to the Lending Rundown. Today we are going to talk about what's happening with interest rates. Mortgage rates were relatively volatile last month, but have calmed in the recent weeks. Last week, the average 30-year fixed interest rate dropped from 5.7 to 5.3, according to Freddie Mac. The Bureau of Labor Statistics released its monthly Consumer Price Index report for June on July 13th. This report is a closely watched gauge of inflation. Pricing immediately after the announcement was worse as markets reacted to the stronger than expected inflation report. The reaction of the inflation data was swift and severe, but after the dust settled, it's nothing like we saw last month. So just how bad was the data? Well, year over year, it was 9.1% versus the 8.8 expected, and higher than the 8.6 we saw in June's report. The monthly was 1.3% versus the projected 1.1. And the core data, stripping out food and energy costs, was 0.7% instead of 0.6. For those that like the numbers, there you go. What do higher rates mean for the housing market? When mortgage rates go up, home buyers' buying power goes down, as more of the anticipated housing budget has to go towards paying interest. However, that doesn't mean that home prices will fail. In fact, they're expected to rise even more this year, just at a slower pace than what we've seen the last couple years. Even with fewer buyers in the market, those who can afford to buy will still be competing over historically low inventory. When there are more buyers than there are homes available, home prices go up. So while conditions may loosen up a bit during the higher rates, we aren't likely to see a significant drop in prices.